My name is Tara Castillo, and I'm a partner in Alston and Bird's Finance Group and a member of the Structured and Warehouse Finance team. My practice focuses on structured finance, warehouse, securitizations, and other asset-backed transactions across a broad spectrum of consumer asset classes. In a post-financial crisis environment, consumer finance companies play a critical role in the U.S. economy by providing an alternative source of funds to both unbanked and underbanked consumers. Due to heightened financial regulatory oversight and scrutiny, which has forced financial institutions to adopt more stringent credit underwriting standards, consumers will continue to rely upon non-bank forms of financing. As a means to fund its operations, finance companies often rely upon different sources of funding, including secured and unsecured bank term loans and syndicated credit facilities. Often, however, such forms of financing are tied to high bank interest rate and fees and include restrictive financial covenants. Onboarding, a securitization strategy from a Treasury perspective, can provide many long-term economic benefits, including diversification of funding sources and access to a lower cost of funds. In simple terms, a securitization is the process by which financial assets, homogeneous in nature, are pooled together and transferred to a trust or a special purpose vehicle. The trust or special purpose vehicle then issues a security backed by those assets to investors in the capital markets. In order to take advantage of economies of scale, a finance company must have sufficient volume, at least $100 million in assets, after taking into account any additional collateral that needs to be included in the transaction from a credit enhancement standpoint. I'm going to briefly discuss 4 high-level legal and operational considerations that a finance company should take into account when determining whether to onboard a securitization strategy. First, is a securitization permissible? As an initial threshold matter, a finance company must review the terms of its existing debt financing arrangements to determine whether securitization is permitted or not. A finance company will also need to work with its senior lenders up front to amend any negative covenants and to also expressly include language that permits the finance company to enter into one or more asset-backed financings or securitizations. Depending on other factors, with the assistance of outside counsel, the finance company may need to negotiate and enter into one or more intercreditor arrangements. Second, a finance company must identify the pool of assets to be securitized. In doing so, the finance company must take into consideration the credit profile of the underlying obligor. It must also take into account the size and term of the underlying assets, and it must also determine whether it has adequate performance history and asset-level data information available. This information will be used by the structuring bank that's ultimately engaged by the finance company to determine the asset's anticipated performance and prepayment schedule over the life of the deal. Third, from an operational standpoint, the finance company must evaluate the current state of its origination, servicing, and compliance platforms. In connection with its business, a finance company and any affiliated originators or servicers must comply with the federal and state regulatory framework that governs the origination and servicing of consumer assets. The finance company must also assess its compliance with all applicable consumer-facing rules and regulations and make sure that it has well-documented policies and procedures in place. Fourth, a finance company may decide to issue asset-backed securities in either the public market, private market, or both. If the finance company decides to tap the public securitization market, then it will be subject to Regulation AB2, which is the framework of rules that govern the public issuance of asset-backed securities. It'll also be subject to ongoing SEC Exchange Act reporting requirements. The private market, however, may seem more attractive to a first-time issuer, since it's currently subject to fewer SEC disclosure and ongoing reporting requirements. Both public and private securitization transactions, however, are subject to the Dodd-Frank credit risk retention requirements. which require the sponsor or a majority-owned affiliate of the sponsor to retain not less than 5% of the credit risk of any assets that through the issuance of an asset-backed security is transferred, sold, or conveyed to a third party. Here at Alston & Bird, our structured and warehouse finance team has the expertise and experience to assist clients in negotiating large and bespoke securitization transactions. We are supported by more than 70 attorneys across our Atlanta, Charlotte, Dallas, Los Angeles, New York, and Washington, D.C. offices.